Okay, hello there. I wanted to hop on here and demonstrate what exactly conservative underwriting means in our case, in this opportunity, in this investment opportunity with Magnolia Park. You can see here the returns that we are projecting, but there's a difference between what we are projecting and what we are expecting. So let's hop over quickly to the P&L, and this will show you. I'll kind of run you through some of the stuff. Up here, you can see our annual rent escalator and our annual expense escalator, and we've been very conservative with these numbers, 1.5% on each, basically canceling each other out. And inflation is right around 3% per year, maybe 2.5%. So, in a lot of cases, you'll see people sort of guess, and with the coming year of uncertainty, maybe they'll say zero here, but then they'll sort of guess and say, it's going to go up to 3 here and, maybe 3 here. And they sort of guess, and really there's no way to do that. So we'd rather just be even across the board and project something low and really just have this deal perform without any rent growth, basically. But rent growth will happen, and we expect it to happen. So let's still be somewhat conservative and say we get a little rent growth in year 4, nothing too crazy, just say 3%, and we'll offset that in expenses with 2.5%, and we'll hop back to our returns, and you can see already we've jumped from 16 to 19%, and the IRR has improved, and our overall total return has gone from 101% to 116%. So already looking pretty good. And let's say we're going to keep our rents basically flat year 1. The reason we're doing that is, the coming year looks to be fairly uncertain with COVID still in full swing. Not sure exactly what's going on with eviction moratoriums. So we've written in some heavy vacancy and kept our rents basically at current rents. But let's say year 2, things improve, and let's bump up our rental increase to set just basically $15 more per year. That's overall current rents. And let's say that instead of having 15% vacancy, let's knock that down to maybe just 13%. And then on year 3, let's just bump this up $8, $7.45. Again, still, these are very conservative numbers, right? We haven't done much. Vacancy still high year 1, not really touching that. Year 2, 13% vacancy in what is a 6% vacancy market, meaning the submarket that Magnolia Park is in has an average vacancy of 6%. We're still saying 13%, so it's still very conservative. And then here, why don't we say 12%? We'll keep that at 12%, and we bumped up the rents a little bit, and then we have 10% vacancy. Let's see where we're at. Our returns, and now we've jumped up to over 20%, 123% total return. Cash on cash has come up a bit because of the rental increases, and that's what we're going to try to do, right? Just because we projected those lower rents that you saw doesn't mean that we're not going to test market our renovated units at higher rents. That's exactly what we're going to do. Still going to be a great value for the tenant base. Still going to be a lot less than the competition is charging for a nicer unit. One more thing I want to touch on is the exit cap. A lot of you are familiar with this. Maybe some of you are not, but it is a very important metric. Right now, the current market cap is actually 6%. And we're saying here in 6 years when we sell this building, we're going a full percentage point or 100 basis points higher than the current market cap. The rule of thumb to be conservative is to multiply 0.1 times the length of the hold. So this is a 6-year hold times 0.1. So that would actually be 6.6 because today's current cap is 6% and we're adding 0.1 times 6. So 0.6%. And look what that's done to to the returns.